if the reputation goes down of that branding, yeah. So, for example, you bought the name Coca-Cola, and then it turns out that Coca-Cola leads to cancer, and the valuation is zero, almost zero. Then you need to write it down, yeah. So that would be the case. But in general, like your own branding or the quality of the sales people, which has a value, of course, in real markets, but you cannot set it up here on your balance sheet. And also on the liability side, it's about tangible liabilities. And if from that point of view, I think it becomes clear that the market value of a company is quite different to the equity capital you see on the balance sheet. So again, I'll give you an example. We've seen that the equity capital of Munich Re was something like 34 billion or so. Yeah? If you would take the stock price today, which is, I don't know, 450, 460 euro, something like that, and multiply it with the number of shares, then you would not get this price. And for many reasons. Why? Because the market valuation is about future cash flows, yeah, that go to the shareholders, yeah? In particular, dividend payments and changes in market value. So it's much more about future cash flows that come to the shareholders. This is not the point of view here, because you could look at current valuation of assets and liabilities, doesn't tell you a lot about future profitability. You have a little bit more of that into the IFRS reporting, like Mark mentioned, because there you have some product valuation profitability in there, but it's not the general setting. And beyond that, you have typically hidden reserves. That also holds true for the IFRS standards. Also there you have hidden reserves, and that also a smart shareholder would take that into account in the valuation. So there's no big surprise that the valuation of the equity capital in the balance sheet is not what you see as a market value. Market value would be the stocks multiplied, the stock price multiplied with the number of stocks on the market. So that's a different valuation. And I think what is very helpful was that Mark said you need to have these different things on your mind as a CFO. So that means you need to look at market values, IFRS, local GAAP, but also solvency requirements, and see if I do this or that change, how will it look like in that particular valuation? Yeah? And none of them is right or wrong, but it gives you different points of view. This is an example of Mobiliar, and that's actually the major life and non-life figures. This is a balance sheet and the income statement based on Swiss GAAP FAIR, because that's what you use. So that is a book value valuation. You could use IFRS, but you have the option, but you stick to Swiss GAAP FAIR, I think for good reasons. And here on the right-hand side, you have the income statement, and I will come back to that in a second, because I would just show you a little bit what else we have, and then show you in principle how an income statement looks like. To wrap it up, I have two slides just to sum it up what Mark said when it comes to the international financial reporting standards on the group level. So that would, for example, Helvetia, Zurich, and AXA, and so on. They would do this kind of valuation. I think it's important to understand that the objective is different. It's not about be on the safe side in the valuation in order to, in a way, get an extra buffer for the policyholders or the customer in general, the debt holders. It's rather to get an objective point of view. How do the financial figures look like? Yeah, so it has more elements of market valuation in it, more and less hidden reserves, like we've seen here in our example, where you typically generate hidden reserves. So this so-called prudence principle that we've seen before, where you remember you need to always write down, yeah, and if you are down, you typically stay there. This plays not such an important issue, even though we have that in some points. The historical costs play a minor role. This is connected. And indeed, you can have gains, which you see in the income state, even so they are not realized to that point. Yeah? And so you have unrealized gains, but also unrealized losses in your income statement. And again, it's important to see that on this IFRS level, dividends and taxes are not paid, because you wouldn't like to see that on unrealized gains, which would be a problem. I think that is clear. And this is a summary of the two things that are in general very different to all the valuation we've seen before. This is what Mark said. On the asset side, you have different valuation. There are three different forms of valuation that you have on the asset side. And you have the liability valuation on the liabilities, the liability valuation on the right-hand side of the balance sheet is different. Yeah, this is IFRS 17. He mentioned that one. Yeah. Let's have a quick look on the asset side, and you can see there are three different ways how you evaluate assets, and there are particular assets that you need to evaluate with amortized costs, which is historical costs. So that is something like we know from our original local GAAP statement, because we use historical data for that one. Yeah? And we can write them down if there are particular reasons, but there are, in a way, book values, and there may be hidden reserves. There are certain assets where you need to use that one. Then you have one source where you have gains and losses, and you can see these gains and losses via the equity capital, but not via the income statement. That is hard to explain why they decided to do something like that. It's something in between. You have income, unrealized gains and losses, but you don't show them right away through the profit and loss. There's a separate box in a way in the equity capital where you can see that. And then you have part of the assets where you have a clear market valuation, and this market valuation can be seen also in the profit and loss statement right away. So, for example, if the stock goes up 100, then you will see it not only in your balance sheet because you have more assets, yeah, in absolute terms, but you also have that in the profit and loss statement right away. Even so, it's an unrealized gain because you still have the stock and it can go down. And I think in particular, I personally think it's a problem that you have not only the mixture out of these two, which is for me hard to justify, but also in general that you have assets that you use book values, assets where you need market values, and you have some freedom as a company to decide. Some are clear defined, but some freedom how you evaluate it. So if you want to compare companies, then you get that information, but it takes time consuming. You would need to go into the statement and see, okay, which asset had been evaluated in which way. You find that, they need to comment on that, but it can be slightly different for different companies, and it is, yeah, because they have some freedom there. If you decided to use this valuation or this valuation, you need to stick to that one. Yeah, there had been one case actually where Swiss Life changed it, but in general, you're not allowed then to change back to some other thing. But still you have some freedom if you're more on the conservative side and try to evaluate as much as possible to the amortized costs, yeah? Or if you're more on the market valuation side, yeah? And that makes it a little bit tricky. And then we had this liability valuation, and Mark explained us this line of reasoning, and this part, well, I think this is very close to what we seen also in other kind of balance sheet and income statements. So that is closer for non-life short contracts, but this is very different to what we've seen before. And Mark explained us this line of reasoning, where you have actually a present value calculus about all the future cash flows, and also an estimation of the profit margin. Yeah, and the profit margin changes in time. And now the things get a bit complex because not all of these gains are realized right away through the profit and loss. There's a particular technique how that will be in a way reflected in the income statement, which makes it a bit complex. I'm with Mark that the way of thinking is in principle right to say what I have today, if I sell a contract today, let's say life insurance contract, it's a present value of future cash flows. There's a present value of premium payments, which is actually also stochastic, yeah? And of course, all the payments that the insurer can do. Yeah, you can calculate present value based on expected payoffs, you do discounting, and there's risk margin. Yeah? And of course, this discrepancy between the present value that you pay as a customer and the present value that the insurance company pays to you gives you a kind of margin. And the way of thinking is right, that it's something like we would do in accounting in general, but it's different to what we did in accounting in former times. Yeah? And so I know it's a quick introduction here. Mark briefly mentioned that. We cannot go into details of that setting, but if you are more interested in, I just gave you 10 pages of, I think it's quite a good, but you find also other sources, of course. I uploaded, or we uploaded, just a summary of how this technique works with an example in it, and I think that's helpful if you want to go deeper into it. Let's go into the income statement, because we didn't say too much about that. Unfortunately, the income statement in our traditional local GAAP and the income statement that you do on the group level, that is slightly different to what you have in IFRS. And I would show you here the traditional income statement. And if you're interested in how it is adjusted in IFRS to understand that, I would also refer to that additional document I gave you. And if you're interested in more details, you can have a look at it. But just to understand in principle how that goes with the income statement. The good news is that is, I would say, easier to understand than the balance sheet, because what you have there, you have a turnover, and then you have expenses, and then you have the profit, and then you need to pay taxes on it if you are on the local GAAP level. And that would hold true for any company that you run. Yeah, so that is not insurance specific. It only becomes insurance specific if we run an insurance company. And if you do so, what would be the turnover in an insurance company? What is the turnover that you have here? What are the major sources? Pardon? Premiums. Yeah, premiums, yes, of course. Yeah. And you would say premiums, clearly the premiums, the earned premiums for that particular year. Yeah, so earned premiums of that particular year. Yes, and the second?
Investment result.
Yeah, an investment result. So that is what we have as a turnover. And unfortunately, that's not all. We have expenses. Expenses, there are two major expenses.
Employees.
Yeah, all I would say all administration costs, yeah, including provisions.
And losses.
Yeah, losses. Losses, then ones we need to pay out and the one which are reserved, okay? And then we need to pay tax on this profit which is there. So exactly, you have a separation of revenues, expenses from the operating activities and others, but the others typically don't play a huge role. Yeah, maybe have some fee models or so, which also generate some revenue, but that is it's a rather small fraction in general. Exactly, we talked about this turnover. We talked about these expenses. So that is a major part. Let's have a quick look to Mobiliar, and I think here we can quite well see it on the right-hand side. Yeah. What do we have? We first have the premium, And you need to adjust that premium, you know that very well, for the ones which are earned and for the one which are relevant for that particular year, 2025. Clearly because, you know, policyholders may pay some of the premiums in advance or the other way around, and you need to adjust it for that particular year. You also have a separate, you separately show what you transfer to the reinsurer. And on the other hand, you have benefits when it comes to claims and also administration costs that you get from the reinsurer. Yeah, you can see that there. And then we are on that second part, and indeed, you see, these are paid claims, but also claims that are reserved. But our estimation for the reserve, which are later paid than 2025. That's what we have in here. You can also see additional costs, so Abschluss- und Verwaltungsaufwendungen. So that is, of course, as you mentioned, employees, but of course the provisions and so on. That's quite a lot of money, if you look at it, 1.2 billion in this case, compared to the total turnover, which is roughly around 5 billion. Yeah? So just to have an idea about the figures. Yeah? We also have the gains or losses from the investment side, as you mentioned rightly, because it's part of the turnover. And here you can see these regular payments, like if you get rent payments for your real estate, dividend payments, if you invest in coupons and so on, but also gains and losses. If you sell specific assets, you have a realized gain or realized loss. And if you sum it up, you can see, okay, we have something like 900,000. Yeah, or you also pay taxes on it, 800,000 as a profit based on a turnover of around 5 million. Yeah, I'm sorry, 5 billion Swiss francs. Yeah, so that is quite straightforward to understand. Yeah, there are smaller positions in which need some explanation. Whenever you need to deal with something like that, what is very helpful is you see here Anhang. And at some positions where you're not sure where does it come from, the Anhang will help you. And actually, typically you have quite good explanations in there. So you see, okay, maybe if you're not sure what that position is, then it's typically explained in the back. You don't need to know that by heart. No, only a few people probably know that. I would like to do a quick reflection and just to show you that this income statement, but also balance sheet, is very general. Yeah? You would also have that in any business that you do. And just as a quick wrap up, so think of you running a kiosk, yeah? And that is what you do. And now you say, okay, you had a successful year and you need to set up your balance sheet, but also you want to do your profit and loss statement. Yeah? Let's say you have to do it because you're organized as a shareholder company and you are the main shareholder. And, yeah, you want to enjoy a limited liability, and that's the reason why you want to do that. Yeah? And just think of what would be on your balance sheet. What would you expect? What are positions you have on your balance sheet? What would be in your income statement? Just to reflect what we would see there. Let's start with a balance sheet. And in such a kiosk, you have some assets. What would be assets you expect you would put there? Yes, Nino.
Anlagevermögen, also Cash,
Ja.
Debitoren,
Yeah.
Bank, maybe Immobilien.
Yeah, investments, if you have something like that.
Investments in general.
Yeah.
Maschinen oder Waren.
Exactly. Yeah. That would be very important. So if this is certainly part of your business, that means all these bottles and whatever you sell there, they are on your asset side too, yeah, because they are assets of the company. What about the kiosk itself? Yeah, let's say it is at the Paradeplatz.
If it's rented or not.
Yeah, exactly. If you own that place, yeah, and maybe also the ground, then you would also have it on your asset side. Yeah. Anything else? Yes, if you have investments and they are part of your business. Yeah. So let's say you had profits in the past. Yeah. It's part of the business. You did not take it out of the business. And you invested not only in bottles, but also in gold and whatever. Yeah. Then it would be on your asset side too. Now we are on the liability and equity side. What would you see there? What could be liabilities?
Liabilities to the Lieferanten, just speaking English term.
Exactly. Yeah.
Sorry?
Suppliers.
Suppliers, sorry.
Yeah, exactly. So I would guess this is something you have, yeah? You did at this point in time, maybe you already got some goods. You did not pay them or not fully pay them, yeah? And that would be a liability for you.
Then credits to buy
Yeah.
the things you want to buy.
That would be a liability if you went to the bank and said, well, that's a great business. Would you please finance it? And they say, oh, yeah, that works all the time. Go for it. That could happen. Yeah, certainly.
Provision for tax, for
Yeah.
salaries,
That could be. Yeah, could be.
social.
Yeah. Yeah. If you're not only running it by yourself, but have other people, and they have pension, for example, pension liabilities for that person and things like that, they would be also part of the liabilities, right? And then you have equity capital. So what is equity capital? Part of the money you brought into the business. You know, when you start the business and said, okay, I invest 1 million Swiss francs. And what else will be part?
From the prior years.
Yes, reserve from prior profits. So if you had profits in the past and you did not take it out, let's say you're the only owner, you did not take it out.
And the current profit,
Yeah. Current
if
profit.
there is any.
Yeah, if there is any.
And the current profit
Yeah.
for the current year.
Yeah, for the current year. Yeah, you could also put it in.
At the end also.
Yeah, if you don't want to pay out or you are not allowed to do it, maybe. It can also happen that you're not allowed to take it out because of your liability side. Yeah, because the bank says, well, you need to leave it here. The profit and loss statement, how would that look like? Let's start with the turnover. What would be the turnover?
Revenues, die Umsatzerlöse.
Yeah.
The
What would-
earnings from selling.
Yeah, that's from selling.
What do you mean so?
So that is, you sell a bottle of whatever, yeah, and that has a specific price, let's say 3 or 4 Swiss francs for a Coke or whatever. And that's a turnover. Yeah. Any else turnover? Probably not. You're probably not doing a lot of service or so services. Yeah. Then you have costs. What are the costs?
Rent, stuff.
Yeah, rent could be staff.
Change in inventories.
Yeah. Of course, everything you pay for the goods. Yeah, that's the important part. What's about yourself, if you run it all the time and it's your time that you spend in the kiosk? Would that be expenses or not?
If it's organized and like a legal person, then you have
It depends.
It depends. Depends how it is organized. Yeah, it can, but may not. Yeah, it may not. So then it would be just opportunity costs because you spend your time there. You would say, okay, I could work at AXA, but I don't do that. And then you compare what is left with the time you would maybe be paid somewhere else. And that would be opportunity cost, but not part of the income. But it depends on the legal structure. That is right. And then you have some profit, which is hopefully positive, and you pay some taxes, and we are done. That is what you would actually do. All right, very good. You have additional information in the annual statement. I briefly mentioned it. I don't want to go into details, but I think what's really helpful is whenever you need to deal with such a annual statement or income statement or balance sheet in general, what you find is there in the notes, the information, how the valuation is done. So in particular, if you're talking about an IFRS balance sheet, you find the information, how is it evaluated? So is it book values, so AC, or is it market value, or is it something in between? You also get information about what you find in these kind of positions. Yeah. So for example, if you would look into Helvetia, you could see, okay, which are real estate, which is used and by Helvetia and owned by Helvetia, and it's separated from real estate that is owned by Helvetia, but not used by Helvetia employees. And so it's a rent model, yeah, it's for income, it's an investment. Yeah? And this information, all this information can be found in the notes, and there you can really use this notation that you see, okay, you find it there and there and there, and then you need some extra time and look it up. So you don't need to know that, you can look it up. So I think that's quite helpful. Clearly, you find a lot of different other information, like salaries of the board members and many other things which may be interesting. In the first part, you also find a description of what had happened within the year and so on and so on. Yeah? There's one thing which is important. You may also want to look it up. If there had been any significant loss or similar things, events, after the 31st of December, because you want to take into account the books are closed at the 31st of December, but of course it takes some time till all the reporting is done. And it could happen that maybe in January, February, something happened, let's say a huge loss or something, which is not in the statement. But they would need to comment on that. Yeah? Or if the board of directors believe it's time to close the company and want to make this offer to the owners, yeah, they could do it in April then, and information like that. And you could find that there too. Yeah? Because the books are closed, you can't see it in the numerics. Yeah, that's it. I think we can close here. Do we have particular questions? I know it's a fast wrap up through the whole balance sheet and also the income statement. Are there particular questions that you have? That okay so far?
I just want to mention that Mark talked about the 65 entities for the local, from the local perspective, but then it's not necessary to have all the entities in the scope of the consolidation of the group. So not everything will be there.
Yeah. So please correct me, but as far as I know, there are in a way 3 forms of ownership. The one is you have less than 20%. Yeah. If you have less than 20%, then it's simply as an investment on your on the left-hand side of the balance sheet. Yeah. Let's say you are AXA and you own some stocks of Zurich. Yeah, but less than 20% of Zurich. If you have between 20 and 50, then it's an associate corporation, and you need to separate it. You have a separate position then, because you are one of the main shareholder in this case, and that's a different situation. Yeah, because I think it's quite clear that you can influence also the way the management will act and so on. You are a different shareholder form. And now the complex thing starts. If you have more than 50%, then you are part of the consolidation. Yeah. So the way this IFRS reporting then is done, you first assume you would own everything. So let's say for all the companies where you have 51, 55, or 95%, first you do or act like I'm owning all of them. And then the so-called, I'm not sure what it is in English, Minderheitsaktionäre, that's a separate part, is then in the income statement, but also in the balance sheet. Then you have a separate position where you show which parts are not owned by you. Yeah? And in the case of Helvetia, it's quite nice because most of the companies where they have, which is part of this consolidation group, is fully owned by Helvetia. And so that fraction, there is a fraction in it, but it's not huge. That can be different if you own, if you have smaller fractions of companies, but they are part. Which companies are part of this consolidation, you find them in the balance sheet or in the annual statement. In the notes, you find the information which companies are that. Yeah? And you mentioned 65 or?
No, you mentioned that there are 65 in Spain, but I know that not all of them are consolidated.
Okay, all right, okay. Because I know in Helvetia, if you look at this annual statement, there's a huge list of all companies which are at least where the Helvetia owns at least 50% plus. And you have that there, and also which fraction they own. This information is also given in that list. Yeah? But first you act, okay, we own it, and then you do the separation for the ownership which is not controlled by you. That's the way how you do it. Is it okay so far? I know it's a quick wrap up, but I think it gives some insights. Whenever you say that's interesting, then we need to find an extra deep dive. I know it's complex because you know how it works, and some of you know that work in that area. A huge number of experts that do that day and night. And so to be fit in half an hour is probably, half a day, I'm sorry, is not that easy. I think we go into the break, and what I want to do is then wrap it up because I have one slide. And in the one slide, I would like to show you, if you have 10 minutes time somewhere and you say, okay, I'm here and I want to get an idea, where is that company located? Is that safe? Is that profitable? What should you look in 10 minutes? Yeah? If you have days, it's different, but if you have 10 minutes, I just want to give you the information, where would I look first? Yeah? Just think of the situation, you were somewhere and it's a customer or so, and you want to have a quick look, what do they do there? Yeah, are they profitable? Are they bankrupt or so? Yeah, and what should you look for? And that's what we do after the break. All right?
Yeah.
So,
Im Anhang sind 9 Entities drin. Aufgeführt.
Für Spanien.
Für Spanien. Ah, okay.
Das ist wegen Unwissenheit.
Wegen verschiedenen Sachen.
good.
Ja gut, ich habe schon eine Idee.
Das ist halt, du machst das speziell.
Capital Quote, Loans.
Deswegen
Ja.
sage ich
Ist
dann
okay.
die 100%.
Zuerst, als ich gesehen
Ja,
habe,
aber
wie
ja.
das so noch